Hello everybody, it's Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is Friday, the 17th of January. I had a pretty busy week, a lot of deals on the go here. Just had a closing happen, so that all is good. Stuff's going on, everybody. You got to pay attention to what's happening in the real estate market these days. So today is not really going to be much of a news day. We'll start that up again next week. Today is more of an editorial, opinion, etc. And what I wanted to do was focus on some stuff, I guess you could say, I wouldn't call them predictions, but things that are likely to happen in housing for 2020. So of course, if you take a look at other videos out there, and I've seen them all as well too, there's titles and all that, there's all these, housing market predictions for 2020. Well, I'm going to give you some of my own. And what we're going to do is we're going to break this down into a number of parts. But for today, I'm actually going to discuss a video that I saw probably about a month ago from an economist. And I think it's good information. And we'll go on his predictions and kind of see how that's going to line up as the year goes. And I'm going to follow with some of my own. So that's the scoop for today. But first, if you're not already a subscriber, please help my channel grow. I'm very close to another milestone here. Just need a few more subscribers. So please click on the bottom right button on the video here and help us grow. I appreciate that. And again, if you're looking for real estate training, drop me a line. If you're looking for real estate investment, as I've mentioned in many videos now, I'm getting more and more deals coming my way. Very interesting stuff going on there right now. I've got a great one that was presented to me late last night. It's a fix and flip here in the Tampa area. If you're looking for information on that, give me a shout, and you got to react, okay? And a lot of people have inquired, but they haven't kind of followed through yet with even, doing some basic stuff. So please, if you're serious about it, there's great opportunities here. I'm plugged into a lot of sources, so certainly, connect with me and we'll see what we can do for you. Okay, so as I said, this really is going to be more on thoughts and expectations for the upcoming year. It's opinion-based, but today it's really going to be based on someone, I don't even know the guy's name, to be honest with you. It's a difficult name to I guess, pronounce, but I'll give you the link in the description section of the video. But, this is the year 2020. So maybe we can go into the year with, eyes open, 2020 vision. That would be kind of interesting, and figure out what's going to happen in housing. So really, I saw this video and I thought it was really good because, it's the point where people are openly talking about what's going to happen with the housing market and giving their views. If you recall the last housing crisis, it kind of hit us by storm. It was a surprise. We were being told by the Fed and other people involved, in housing policy that there's never going to be an issue. There won't be problems. It's a small blip in the marketplace. And look what happened. Millions of people lost their home to foreclosure. We had the Great Recession. So this time it's going to be different. There's going to be problems. There's going to be carnage going forward. It's going to be probably managed a little differently, and we'll probably have some little different outcomes and expectations. So, but again, I like it because we're open to talking about it right now, which is really important. So, as I said, I saw this on CNBC, and it was an interview with the chief economist of Lending Tree. And I'll sort of give you a breakdown of what he said, but why I appreciated it was, number one, for his frankness. He wasn't pulling any punches. He wasn't trying to sugarcoat the market. And again, we all know that, different people or different groups, companies, organizations, whatever, are going to spin the housing market with respect to what benefits them or what's in their own self-interest, right? People say that I'm doing that on this channel here too. Actually, I really don't think so. I know there's distress there. I know there's issues that are going to happen. I'm telling people to be prepared for it, to look for it and try to navigate around it, and to buy homes at the best possible price that you can. So here's what he had to say. We're going to see in 2020 continued price deceleration. And why is that? Well, because of affordability challenges. We have affordability challenges now. We have in the past year, the year before. We're going to continue to have them. And he said that the way housing is priced right now is unsustainable at the moment. So if they're unsustainable, where are they going to go? There's only one way they can go, and that's down. So please expect some decreases. He says since 2012, which was really the bottom, the trough. Remember, we had 2006 peak, and then we crashed, and it just kept going. 2012, right there was probably the lowest point in housing value. You can take a look at Shiller to verify this, but I do agree that that's around that time frame. That was the lowest point you could be in housing value, which really would have been the best time to purchase a home for your primary residence or investment, etc. You would have got the best prices. Well, since the bottom in 2012, home prices have risen 3 times compared that to the rate of income. So even though we can take a look at the marketplace, the economy, we can take a look at jobs, and we can listen to what we're being told. And again, that's up to you to figure out whether you believe that or agree with it or not. But if we have great months where unemployment's gaining, there's less and less people looking for work, everyone's happy. Well, being employed to me is a pay count. It's really what you're bringing home as far as income that really matters here. So again, he's saying that home prices have risen 3 times compared to the rate of income, that we need to see some of that momentum slow down, and it will happen in 2020. So eventually, our incomes are going to peak. We're not going to keep getting higher and higher, wage increases just because companies can't afford that, and it's just not going to be, it just can't go on forever, obviously. So he basically said that's going to lose momentum and things will start to level out. He's expecting to see about a 3.5 to 4.5% overall decrease across the board. Now, this really is not a huge decrease in pricing, and to be quite honest with you, I believe it is kind of conservative, but this is averaging out across the board. So different metro markets across the country, again, you got about 220 what I'll call major metro markets. Some will see greater decreases, and we're seeing that already with some of the mega cities like San Francisco and New York, etc. And those cities are having their own issues. I know New York, especially Manhattan, is having an inventory issue the other way now with respect to more and more, we'll call it condos and apartments, are being put on the marketplace, and there's a lot of shadow inventory that hasn't even hit yet from developers, etc. So that's going to happen. And when more inventory hits, we're going to see price decreases. So if he's saying 3.5% to 4% across the board, think about that right now. So you buy a home today and you drop 4%. All right, you need to sell. Well, guess what? You've already lost 4%. With respect to closing costs, now you're breaking even potentially, adding some commission on that. Now you're effectively underwater and having to bring money to the table to close out your transaction if you want to sell. So that's kind of where we are now. We're kind of on the sort of, we're at the point where we're tipping and it's going to move forward. So that's kind of his thought on that, which I think is conservative. But again, he's not calling for increases. He's calling for decreases across the board in home value, unlike other, we'll say, I won't call them economists, but other corporations or groups, organizations that have a self-interest in having the housing market increase in value. And again, we're seeing deceleration. So deceleration will be occurring. He agrees with this. He also mentioned inventory is still an issue. So we've all been talking about that. Well, the point though is that faster home appreciation has been in the affordable housing or lower market segment, at the low end of the market. So that's where we've seen the big appreciation. The high end of the market, the appreciation has slowed down, and there's much more accumulation of inventory in that range. So the higher end homes take longer to sell. We know that less and less people can purchase them just based on demographics and income, and there's more inventory accumulating there. So we should see eventually some price decreases at that level as well too. And again, going back to sort of what I thought and did happen in the past housing crisis, that you see the bigger cities having the issues or showing them first. They're much more extreme, and you always see the higher end dropping prices because typically they may have more room or more margin to drop prices when they're putting stuff on the marketplace. So we see that happen first. Now, we should see an acceleration in housing starts in 2020. So housing starts are contracts that are signed with buyers and home builders. So we've been tracking that, every month there's a track that goes on. It's the Census Bureau and then home builders, etc. They track, housing starts, permits, whatever. So we're going to see an acceleration in housing starts in 2020. However, new home construction only accounts for about 10% of the overall market. So if we see if we even see a significant increase in housing starts, that's really going to only satisfy a small segment of the marketplace. And again, realize that when you compare existing home prices and new home prices are more expensive on average. Why is that? Well, of course, because it's a new home. You're actually getting a home. When you jump into a home today, it's a brand new home. What do you have? A brand new home. You don't have deferred maintenance. You don't have to put on a new roof or buy new appliances or get new flooring, new air conditioners, whatever. When you buy a new home, you're good for probably 10 years, I would say that. Maybe you might want to do some painting on the inside, but think about it structurally, the AC systems, the roof is all 30-year, high durable shingles, windows are, especially down here, are hurricane rated. They're great. I mean, there's not much that you will have to do, within the first 10 years of the new home, other than decorate or paint or do stuff internally, which is your own preference. So, and because of that, you're going to pay obviously more on average for that home. And we actually just saw towards the end of the year, and the new home median price increased actually. It was decreasing before, then it popped up again. So that's still going to be problematic for some people to afford to do that. But again, he sees acceleration housing starts in 2020. Apparently builder confidence is great. We still haven't seen that out in the statistics, but coming through on sales, but their confidence is up and they probably expect they're going to get, as I said, they're going to get a pickup this year with respect to lower rates, etc. So that's kind of scoop on the new housing market. What he said we need is people moving out and up. So what we don't have is movement. We have people who are either, staying put, they're either aging in place, which we've talked about. The baby boomer generation has aged in place and a lot of them are not moving out. And why is that? Well, because they have adult children living with them. People, either they haven't left or their kids have come back because of their own income or challenges in finding their own accommodation. That's going on. We also know that to move out, especially from that generation, part of the proceeds are going to be used to fund the retirement. So if you're looking to cash out on your current home, you want to move into something smaller, well, because the smaller home and lower price have appreciated more so and are tougher to get, you're paying a premium. So taking your money when you cash out from your current home, you're not actually gaining anything when you move it to a smaller home. So that's why people are holding on. They're going, it doesn't make sense for us to do this. So that's kind of an issue right there. Also, this is very important to think about. He says people are staying put and the impetus to move is not there. And why it's been diminished? It's because of the digitization of the economy. This is a really important point. So, I can tell you firsthand that, because I see this, that more and more people are doing their business or doing their jobs remotely or at home. So we see this in the fact that, look at, I guess you could say the malls. Okay, well, we're buying online. So the economy is digitizing. So guess what? Had a record number of store closings last year, which means, people aren't going out to shop. They're doing everything from their home. People are working from home now, all right? You can do your job from your house. I mean, a lot of employers encourage telecommuting where they're not having to keep floor space and provide, whatever they need to provide if you can work at home. A lot of call centers now have agents that are working from their home because you have technology. You can actually, with the internet, get a phone set, you have a VoIP phone, you get your monitor the whole bit. Guess what? You can now operate your job from your house. So you're in the comfort of your own home, and that's saving your employer money, time, effort, etc., trying to get more out of you, of course. So we're seeing this happening. More people are creating their own businesses. More people are entrepreneurs. So there's so much going on in the digital world right now that you don't actually have to move to a job. So that whole, we got to move someplace, I'm going to sell my house and move and relocate. There's less of that going on right now. So people are staying put, which in turn means less property hitting the marketplace, which means less inventory for you and I to purchase, which, again, causes a crunch and then causes prices to remain. That's a scoop on that. So please keep that in mind. I think that's a very good point. Our whole world is changing with respect to the computer, the internet, the handheld devices, the pads, whatever you want to talk, it's there. Now, when you take a look at that, a good example is the housing market. So let's talk about the housing market. Well, it's become digitized. It's almost 100% digitized, all right? So more and more people, what do you do when you're looking for a home? You don't call up your real estate agent and say, hey, find me a home. What do? You go on third-party websites and look for available property because it's there. So you're doing the search from your handheld or from your laptop, whatever your desktop, whatever it is, you're doing that search first. When the time is right, you may request assistance from a real estate agent, but you may not. And we all know about the iBuyers. There's more and more iBuyers out there right now. There's about, they're hitting the marketplaces. So eventually every major metro market will have at least one iBuyer there. So once again, it's giving you a clean and simple way to sell your house and move out and move on. And so that it goes to them, you're not having, so your average buyer is not able to jump in on that. Everything's digitized, all right? Getting pre-approved for a mortgage, same thing. We've got the applications, we can do it by hand, off you go. it's easier. And I read a lot of articles about the digitization of the mortgage industry and the closing title. So eventually all these iBuyers, whether they buy and sell you homes, have their own title closing, their own mortgage, everything like that. So it's all done remotely, and artificial intelligence will be taking over from a lot of that and less human interaction. So we're already there. Again, closings are all done via email now, etc. It's not a big deal. And as I said, you don't have to engage real people. So this industry that we're in right now basically has become digitized. So that's just one example of what's happening to other industries, across the board here. You got more outsourcing, more offshore, more virtual assistant, more VA. So again, you don't have to leave the comfort of your residence, whether it's apartment or home, to work and earn money, which means you don't have to relocate. All right, and I also mentioned, as I said earlier, the baby boomer generation not moving out, downsizing is too expensive, adult kids at home are coming back, and we've seen about this what's called the tsunami of the silver tsunami in the future, starting probably in 2023 or so, when more people just because of their age will just need to sell. They're choosing not to sell now, but eventually more of this will sell in the future of the baby boomer generation. But we're not quite there yet, so it's causing the gridlock, which is inventory issues. All right, so that's the scoop on that. Now, we also mentioned mortgage rates. So we said difficult to see rates declining this year. Again, he said, if anything, we should see them rise a little in 2020 to stabilize. So really, you've kind of hit rock bottom with mortgage rates. So your buying power has increased, which is cool. But that was his perspective. So we're not going to see any more of the rate increases, according to him. And again, he is the chief economist for Lending Tree. That's his position here. Now, I did read something the other day about that there's and again, most people are in agreement that we're going to see no rate decreases. The Fed came out and said that it was going to stay solid for 2020 with no movement, but we see some other opinions popping up right now. And it's funny, there's a bank in Switzerland called UBS. They're one of the world's largest investment banks out there. They actually sort of differ from what he said. They predict the Fed may actually cut rates in 2020 up to 3 times. And the reason they say it says conventional wisdom says the Federal Reserve won't cut rates anytime during 2020. However, we don't live in conventional times. So UBS, one of the world's biggest investment banks, is predicting the Fed could lower interest rates 3 times in 2020. An outlook which is at variance with other economists across the board who are calling for no change or maybe just 1 rate decrease here. Basically, if it's correct, obviously it'll put more pressure on rates to go down. Damage, and the reason why they say damage from tariffs not covered under the Phase 1 trade deal signed by the president on Wednesday will force the Fed to ease monetary policy, and that will again reduce rates, which will eventually factor into reducing mortgage rates as well. They don't expect it to be a financial shock. The reason being because the slowdown's already been predicted by the Fed, but it'll be worse than projected. So we already know there's a slowdown, but why they'll reduce rates? Because it'll be worse than predicted. They're not going to admit it right now, so that's why the rates are holding. They will eventually drop. That's this again, UBS. They're a big bank out of Switzerland. That's their prediction right here. So that's a scoop on that. So really, we take a look at 2020 in summary here. And again, I'm just reiterating what I read and what I listened to on a video, and sort of regurgitating that for you right now. I will give my opinions in the next couple of videos. So we'll call this, predictions or what's going to happen to housing, in 2020 part 1. All right, and I'll be adding a few more because I've got about maybe a good 7 or 8 points that I want to make with respect to the housing market, where I'll sort of dive into it and sort of show where I think it's going to go and the reasons why and the data to back it up. So as you know, I like the data, and everything that I talk about is because I'm looking at what's happened in the past, the signals that we're getting right now, and what's going forward. So using the whole 2020 kind of acronym, moniker, whatever, and hindsight is 2020, we should be using what's happened in the last housing crisis and what's gone over the past number of years to predict what's going to happen forward with respect to housing in 2020. So having said that, once again, I thank you all for your time today. Thank you for the reviews, likes, and the comments. Please share this video with your friends, family, and colleagues. That would help me a lot. If you're not already a subscriber, please click the subscribe button. I'm very close to another benchmark in my channel's growth, so I'd love to have, I've got a handful more subscribers and I hit that benchmark, so I'd appreciate it if you would subscribe. And again, if you're looking for more information on real estate training, short sales, and real estate investment, whether it's buy and hold or fix and flip, which as I told you, I'm getting a ton of deals down here right now. Things are changing, which is interesting in our marketplace. Sometimes, market changes, or people release inventory because they want to do other things, and so we're getting the benefit of that right now. So please give me a shout and I can get you set up with a great deal if you'd like. So anyway, thanks again. We'll look forward to speaking with you early next week.